Hello, everyone. Greg Sykora here with Mark Zavitz. Sorry we missed the last few months of updates because we were moving the office, but we look forward to resuming our monthly updates. We're going to quickly recap what's gone on in markets since the beginning of the year, discuss things like stocks and gold prices, and then finish off with why we're still optimistic 2026 will be a good year for your portfolio. Let's get started. So first and foremost, although I think all of you should have received a letter of notice, we officially relocated to 261 Martindale Road, Unit 9, about a month ago. So I've signed a 5-year lease. This is where we plan to be for the foreseeable future. We've also rebranded, as you probably saw in one of our letters that went out at the end of the year of 2025, from Zavitz and Sykora Financial Strategies to Sykora Financial. Mark and I and the team, we all look forward to seeing you here at some point over the next year or so. So, what an interesting past 3 months we've had. The first 2 months of the year were dominated, well, aside from the Epstein files, they were dominated by the Supreme Court in the United States' decision to label tariffs illegal, or at least Trump's rationale for enforcing them, which in turn forced Trump and his administration to backtrack on his Liberation Day tariffs. Markets really liked this and rallied on this news to start the year. But then, of course, a month ago, the United States and Israel decided to attack Iran. Rationale for why they attacked, aside from the fact that, the geopolitical risks and the fact that Iran's kind of been a pest for the past, 2 decades or so, and the fact that they're potentially developing nuclear technology, it doesn't seem like the United States and Israel anticipated such a pointed response from Iran. And ultimately, they're stuck in a war they likely can't win. Iran and the various vassals they control in the Middle East have essentially closed the Strait of Hormuz, where 20% of the world's oil and natural gas ships from. Right now, they're holding oil and natural gas cargo ships hostage for millions of dollars. It looks like they plan to recover their financial losses that way while attacking energy infrastructure with ballistic missiles within the area. So they've attacked, Turkey, they've attacked Saudi Arabia, Dubai, all these areas. Although I anticipate this war being short, likely given the fact that Trump appears to be tacoing out or chickening out, none of this is good for stocks, for bonds, or for gold. Stocks are worried about energy prices eating into stock profit and company margins. Bond markets are worried about inflation and higher rates. And of course, when rates go up, bond values go down. And gold does not like inflation because it depresses precious metals demand. Ugly all around stuff for investors and most people's portfolios. And of course, as many of you know, we do not believe in buying or holding individual stocks simply because nobody can successfully pick stocks, not even the pros with their PhDs or their CFAs. Since the beginning of the year, some of the last year's biggest winners and the year before's biggest winners in terms of stocks are getting absolutely pummeled. So over the last 3 months, you can see the biggest 7 companies in the world, their performance year to date is horrendous. From the top, you've got Microsoft all the way down to Facebook, Tesla, Amazon, Google, Nvidia, and Apple, all almost down double digits, some down over 20%. That being said, you own these stocks, although a very small portion of them, you own these stocks given the composition of the ETF portfolio and the DFA funds you own in your portfolios. Most clients, though, are down anywhere in the ballpark of 1 to 5% year to date. From having been up somewhere around 2 to 5%, you're down 1 to 5%. That's around a 3 to 9% swing you're not down nearly as much as these individual names. You're likely doing much better than someone who owns and buys individual stocks, or an advisor that owns and buys individual stocks for their clients. And I already mentioned gold. Now, there was an old saying when I was back working on Bay Street: buy gold when you're worried about the future, sell gold when you're worried about the now. When I worked downtown on Bay Street, that was an old adage I heard from a hedge fund manager. Over the past 9 months or so, as you can see on this slide, gold prices crested around all-time high of $55,589 from about, we can say, second quarter, third quarter of last year till about the highs of this year. We've been suggesting clients trim back their gold. Either I've reached out to you or we've done it in our reviews. Almost everyone that we've had a meeting with was overweight gold. Not everyone, but most people were overweight gold in their portfolios. And we sold it back to a 5 to or a 10% weighting in their respective portfolios, depending on the model that they're in. At this juncture, this appears to have been a prudent move. Gold is down about 20% from those highs. Mark, what's your take on what you're seeing with gold prices and I guess precious metals in general?
Well, like from the beginning, I mean, the gold and precious metals have been attracting capital for companies, individuals, and governments that have been trying to diversify away from the US dollar, right? So there's been a lot of concern over the last several years, but particularly, at the end of last year and certainly the beginning of this year. As you can see, gold went from 4,400. At one point, it had an intraday high of almost $5,600 an ounce. And that's just not sustainable, right? So the fact that you were trimming gold in portfolios was very prudent. That's what you're supposed to do. That curve there is like, curves we've seen with tech stocks or with cryptocurrency. It's just not sustainable. So the fact that there was a 20% sell-off actually makes sense. But my view for gold is, in the last 6 weeks, we've had a rush back to the US dollar. People, obviously are very concerned about what's going to happen with rising oil prices, with the war in Iran, with inflation, like you said, with corporate profits. They're concerned about the bond market, they're concerned about everything except cash in the last, month. But going forward, the drivers for gold are still mostly in place. What's an appropriate value for gold? Who knows? But the fact that it's come off 20%, or maybe even a little bit more from the all-time high, like I said, I don't know what the appropriate valuation is for gold. Nobody knows. Same thing with cryptocurrency. Same thing with a lot of things. But I think it still serves as a diversifier in portfolios. We don't buy it to get rich. We buy it to add stability and to be different, right? And there's going to be periods where it goes way up. There's going to be periods where it goes way down.
Yep.
The reason you put 5 to 10, maybe even a little more for a few clients in a portfolio is because it's one of the only things left where you can get some diversification.
Yep.
And that reduces the beta of the portfolios. It reduces the risk and the volatility, and that's why it's there. So we'll keep it there, unless something radically changes. Clients should expect to get a call from us, particularly you, to trim when it goes way up.
Yep.
And there might be periods in the future to add when it goes down.
That's right. Yeah, it's all about portfolio construction, and you own asset classes that perform differently at different times. You increase the risk-adjusted returns of the portfolio as long as that asset class has a modestly good expected return. And gold, for what it's worth, if you own it as a 5% weighting for most clients, it increases the risk-adjusted returns of most people's portfolios. It's as simple as that. So I'd say about, 80, 90% of all clients have about a 5% weighting. A few who are ultra conservative have 10% or more, but in general, that should be where most people are at in perpetuity, like forever. And that's typically what we're going to rebalance to if we have a review with you and we meet with you once or twice a year and we see that your weightings are out of whack, that we sell if you're at a 7 or 8% down to 5. And we've been doing that for almost everyone that we've had a chance to talk to or meet with.
Yep.
So when it comes to stocks and equities and portfolio performance, are we worried? Yeah, absolutely not. A 10% correction in stocks, a 3% correction in bonds is par for the course. Here's a chart plotting various geopolitical and black swan events that have occurred over the past 17 years. On average, stocks go down 10% almost once a year. It's once every 1.2 years. It feels worse each time. Why? Simply because markets trend higher over time. So the value of 10% in most people's portfolios gets larger and larger. Still, even if this drop takes some time to recover, we continue to hold and try not to time the markets. The only thing I ever recommend doing in terms of market timing is if we have a mass correction, like a global financial crisis or a tech market type correction where stocks are down 40 to 50%, that is actually when I would suggest many people ratchet up the risk of their portfolio, go from, say, a conservative asset mix to a moderate or a growth asset mix. But at this juncture, with a 10% correction, the thing to do is nothing. So why else am I optimistic? And, as I alluded to at the beginning of this press, even though I think it may take a few months for markets to course correct, and I think it will be a few months because it looks like Trump is chicken tacoing out, the backdrop for stocks heading into the year was quite strong. The last time we had company earnings like this or corporate earnings like this, as robust as they are, was in the mid to late 90s, which was one of the best times for markets globally and for North American markets. So markets were coming in from a place of strength with double-digit earnings growth. When earnings growth is in the teens, North American equity markets typically return double digits. That's where they were coming from in the past year, and that's where they currently are today. Who knows what earnings growth is going to continue to be, but I don't really see a reason yet for why they can't continue to be double digits. And as I mentioned at the beginning of this presentation, in the first 2 months of the year, Trump's crazy, nonsensical tariffs were neutered down to 10% by the Supreme Court, although he's trying to ratchet them back up to 15%, much lower than what U.S. consumers had previously been paying. 10% globally on average is a lot different than 20 to 30% he tacked on to certain countries, although certain industries are paying 20, 30, 40, 50%. Overall, this is a tailwind for the U.S. consumer, believe it or not. It's lower than what they were paying before. Mark, do you want to end things off with any thoughts on what's going on with tariffs and some of the stuff Trump's been doing or he was trying to do here?
I mean, the when he came up with that chart with the tariffs on all the countries and threatening, and as you said, 100%, 200%, 1,000,000% tariffs, coming out with tariffs every day, off the next day, on the next day. It's just a very, very difficult situation for businesses to operate in globally. So the fact that we have some certainty now, more certainty with tariffs, and they're quite a bit lower, and the Supreme Court has kind of said, hey, what you did is illegal.
Yep.
Like you said, that's a tailwind. That isn't a perfect environment, but it's it's a lot better than what we were looking at, 12 months ago.
I agree. And anyway, who knows how successful he's going to be with the various other levers he can pull. But while he's distracted with what's going on in Iran, in the Middle East, and insulting allies, and it's continuing to insult Canada and everybody else who's part of NATO, I don't necessarily believe that he's going to revisit the tariff situation and try to force higher tariffs in. I think he kind of gets it, right? Like, he's seen his support drop significantly over the past month or so, from around a 40% level down to a mid-30s level. And I think the political heat, as they get closer and closer to the midterms, is going to force his hand to back off here. We have yet to see, but I think there's a strong probability chance that happens. All right,
Agreed.
everyone, this has been over 20 minutes. Thank you so much for listening to our update. We look forward to resuming these regular updates every month. Have a good month of April, and tune back into our April monthly update at the end of the month. Thank you so much. Take care.
Sounds good. Sounds good, Greg. Bye, everyone.